All right, so let's take a look at another exercise as we familiarize ourselves with accounting and how all of these numbers kind of move together and actually mean something. The name of this exercise is recording transactions using journal entries and T accounts. So if we were doing this, it's kind of an online assignment, what we would probably have is like a separate window for the T accounts. And so what I did was I made another video where I deal with T accounts. So even though we have T accounts mentioned in this exercise, we're going to put a little line through that, and we're only going to focus on journal entries. We should also note that journal entries, once they are posted, go to the general ledger, and then when we close out a period, they end up populating the financial statements. And so T accounts, conversely, are simply to reconcile the balance of an individual account. So again, we have another video on T accounts. So we're going to focus our attention on journal entries. And also, as we go through these journal entries and make them, I am going to kind of talk a little bit and include some dialogue about what is the impact overall on equity. So equity, or stockholders' equity, is a balance sheet account, but we kind of need to know what's going on with equity as we go through these. Okay. So we have a total of 9 journal entries that we're going to do, and our handout here is labeled 1 through 9. We would normally include a date on these journal entries. We do not have dates, so we cannot do that. Number 1 says that we're going to receive cash in exchange for common stock. All right? So if this is what's going on, this looks like a situation, at least in our scenario, we're going to pretend that this is a brand new business, and maybe it's your business, and you have decided to take $20,000 of your own money and invest it into the business. So these journal entries, very important that we recognize they're from the business's perspective. So from the business's perspective, cash has gone up by $20,000, and cash goes up on the left with what we call a debt. Okay, and so I'm going to plot cash here, and I kind of made it over on the left side, and then our debit figure is to the left of the credit figure. All right. So what did you get for your $20,000? Well, you got common stock or capital stock, some type of stock account to indicate owner investment. All right. And equity accounts have what we call a normal credit balance. So that's all we have to do for the journal entry. What we would essentially say is that if this is a brand new business, we should think about each of these transactions that we're recording with the accounting equation in mind of assets equal liabilities plus stockholders' equity. And so if this is the case, we would now have $20,000 in assets, $0 in liabilities, meaning we would have $20,000 in equity. All right, so equity would have gone up by $20,000 in this transaction. Number 2 says we're going to purchase $2,000 of inventory on credit. So we have to pay attention to how these items are worded. We purchased inventory, and inventory is an asset. So I can go ahead and I can record inventory here, and I can do so for $2,000. And I can also go ahead and put in my credit amount of $2,000. But what is this account? Now, notice if we were doing this online, we would have a little drop-down box, but the way we're doing it is a little bit better because we don't have the drop-down box, right? So, what we're going to say then is we have, because we purchased this inventory on credit, we have incurred a liability. And we're going to call that liability accounts payable. I say we're going to call it that. I mean, that's what it is. So, what is the impact on equity? Well, assets went up by $2,000. That's the good news. Bad news is liabilities also went up by $2,000. So, if we were doing this, let me go back up to this first transaction. We would say equity up 20K. For this transaction, equity equals a dash or nothing. No impact on equity for the second transaction. All right. Number 3, it says sell inventory for $3,000 on credit. All right. So we're going to have, looks like, a few of these transactions that are related. But the first thing that we're going to do here, it says we're going to sell inventory for $3,000 on credit. So we had an account payable when we bought the inventory on credit. But when we sell it on credit, we have an asset, and that asset is called accounts receivable. Okay, and we sold it for $3,000, so $3,000 is the amount that is owed. And you say, okay, well, now what's our credit? Well, it says that we sold inventory, so we're going to call this sales revenue. Okay, and revenue accounts have a normal credit balance. It's also important that we recognize right here that equity went up by $3,000. All right, equity went up by $3,000. Number 4, now it didn't really go up by $3,000, and I'm going to show you why. Number 4, because essentially at the exact same time, we have to record the $2,000 cost of the inventory. So we're going to introduce, if we haven't seen it already, we're going to introduce an account called cost of goods sold. And you'll often see this abbreviated as COGS, C-O-G-S, because it's kind of a long thing to write out. All right. And so this is this is an expense account over on the income statement. And so we're going to expense now that inventory because we no longer have it. Well, if we no longer have it, this inventory that went up in number 2 needs to come down because we no longer have it. So we're going to credit the inventory because asset accounts go down with a credit. What is the impact on equity? Equity went down by $2,000. Okay. So what we would really probably say in reality is that transaction here in number 3, when we consider everything that's going on here, equity increased by a net $1,000. We got $3,000 in sales revenue and a $3,000 asset, but we also have a $2,000 expense and the reduction of an asset by $2,000. Okay, so receivable went up by $3,000, which is an asset. Inventory went down by $2,000. That's $1,000. Or we can look at it the other way. Sales revenue went up by $3,000, but other income statement account was an expense account, and it went up by $2,000. So we can take an income statement or balance sheet approach to figure out how much equity went up in the aggregate. But again, for number 4 by itself, equity went down by $2,000 after going up by $3,000. All right. Number 5, also very, very important. It says collect $3,000 cash from transaction number 3. Say we're collecting cash. So cash is an asset. It's going to go up with a debit. So here's our $3,000. And what happened alongside of that is that our accounts receivable, let's see here, I almost had a misspelling there. Accounts, let's see here, receivable went down by $3,000. So just as we had inventory go down in this transaction, we have an asset go down here. What is the impact to equity? Nothing. We already increased equity as soon as we sold the merchandise because we're using the accrual basis of accounting. Here, even if we didn't know that, we need to be able to say, okay, well, cash went up, so we have an asset going up by $3,000, but another asset went down by $3,000. Therefore, there is no impact on equity. All right. Number 6 says acquired $5,000 worth of equipment by signing a note. Well, equipment is an asset. By signing a note. Now, we don't know how long we have to pay this note, so we're not going to worry about that. But this is a little bit different. We're going to call this a notes payable. And that is specifically for if we have issued someone a note. Okay, so we have $5,000 asset that has gone up, but we also have a $5,000 liability that has also gone up. So remember, anytime you see the word payable, you should know automatically that we have a liability we're dealing with. So the impact on equity equals nothing. The $5,000 increase to the asset was offset by the $5,000 increase to the liability. All right, so let's move up the paper here a little bit. Number 7 says that we pay wages of $1,000 in cash. So normally what we would do is we would recognize an expense for those wages and then a liability, because if you've ever had a job, you understand that you don't earn the wages and get paid for those wages the same day as a rule. You get paid like 2 weeks later for the work that you did today, right? So we're kind of skipping past all of that. And so what we're going to do here, based on the information that we have, is we're going to recognize wage expense. Notice that all expenses have a debit balance. So as expenses go up, they do so on the left. Unfortunately, expenses usually don't go down. And then we're going to, we used cash for that, so we're going to credit cash because assets go down with a credit. What is the impact on equity? It goes down by $1,000. Do a little bit better on our K there. So important to recognize, we have an asset going down by $1,000 and no decrease to a liability. We just have an expense. So this reduces equity by the $1,000. Number 8 says we're going to pay $5,000 on a note payable that came due. We're ignoring any kind of interest or anything here, I guess. And so we set the note payable up with a debit. Now we want to get rid of it, so we have to go the other direction with a debit. So we're debiting the note payable for $5,000, and we paid the $5,000, so we did that in cash. The impact on equity equals nothing, because yes, we reduced the asset by $5,000, but we also reduced the liability by $5,000. Again, we're For purposes of this exercise, we're ignoring any type of interest that would have been paid in addition to the note. And then number 9, we're paying a cash dividend. So dividends are neither an income statement or balance sheet account. And I'm going to put in parentheses here cash because I should have probably written cash dividends. So cash dividends go up. Now this is not an expense, but actual cash has gone down. Okay, so this is kind of one of those things we have cash going down, and then probably the easiest way to think about this is that we don't have a corresponding liability that has also gone down, nor do we have another asset account which has gone up. We just have an asset account which has gone down. Okay, so dividends are kind of bizarre because we don't really see the impact anywhere other than to the cash balance, and then we would also actually see, if we could keep up with it, we would see that retained earnings would go down on the balance sheet when those dividends were paid. But that's about it, right? So we could probably get a little bit more into a discussion on dividends, but this video is over 16 minutes now. So we're going to close this out. And again, do recall that we have a separate video for the T accounts.